Wall Street reached new record highs this week, driven by a significant rally in Nvidia Corp, NVDA, which became the first company to exceed a $4 trillion market capitalization. This milestone has generated optimism within the tech and AI sectors, as Nvidia's share price nearly doubled from its early April lows in just over 3 months. The surge in Nvidia's stock has contributed to the combined market value of the Magnificent Seven tech giants: Apple, Microsoft, Amazon, Meta Platforms, Alphabet, Tesla, and Nvidia, reaching an impressive $18.3 trillion. This bullish sentiment in the tech sector underscores the growing investor confidence in AI-driven growth. In contrast, President Donald Trump's announcement of a 35% tariff on Canadian imports and proposed tariffs on other trading partners has reignited trade war concerns. Additionally, the introduction of 50% duties on copper and Brazilian goods, along with Trump's call for a 3 percentage point rate cut by the Federal Reserve, has added to market volatility. The Fed remains cautious, with minutes from the June FOMC meeting indicating a potential rate cut later this year. Although Chicago Fed President Austin Goolsbee emphasized that monetary policy should not be driven by debt costs alone. Meanwhile, airline stocks saw strong performance, with Delta Airlines leading the way after surpassing earnings expectations, and Bitcoin surged past $118,000, reflecting increased institutional interest in cryptocurrency.
Sarepta Therapeutics, Inc., NASDAQ, SRPT, is the subject of a class action securities lawsuit filed by the law firm Levi and Korsinsky, LLP. The lawsuit alleges that between June 22, 2023 and June 24, 2025, Sarepta engaged in securities fraud by making false statements and failing to disclose significant safety risks associated with its gene therapy product, Levidys, which is intended for the treatment of Duchenne muscular dystrophy. The allegations include inadequate clinical trial protocols that failed to detect severe side effects, leading to a halt in recruitment and dosing in the Levidys trials and increased regulatory scrutiny. Investors who suffered losses during this period are encouraged to join the lawsuit, with the deadline for lead plaintiff applications set for August 25, 2025. The legal proceedings could have substantial implications for Sarepta, potentially affecting its stock price, market perception, and future operations. If the allegations are substantiated, the company may face financial liabilities and reputational damage. Additionally, the outcome of this case could influence regulatory perspectives on gene therapy safety protocols, potentially affecting the broader biotech sector. Investors are advised to closely monitor the situation, as it could have broader market ramifications.
The S&P TSX Composite Index in Toronto and U.S. stock markets, including the Dow Jones Industrial Average, S&P 500, and NASDAQ Composite, experienced declines following President Donald Trump's announcement of a potential increase in tariffs on Canadian imports to 35%. The S&P TSX fell by 59.05 points to 27,023.25, with the Dow Jones dropping 279.13 points to 44,371.51. The S&P 500 and NASDAQ Composite also saw decreases, pulling back from record highs. Despite these declines, the market reaction was relatively muted, indicating that investors might be adjusting to the volatility associated with Trump's trade policies. The proposed tariffs target non-CUSMA-compliant goods, potentially straining U.S.-Canada economic relations. However, trading volumes remained light, and indices stayed near record highs. The Canadian market showed mixed performance, with technology and healthcare sectors declining while commodities like oil and gold saw gains. Notably, Celestica Inc. in the tech sector bucked the trend with a 1.56% rise in shares. Meanwhile, the Canadian dollar remained stable at 73.08 cents US, reflecting cautious investor sentiment amid trade tensions. In Canada, the economic outlook is bolstered by a strong labor market, with 83,000 jobs added in June and the unemployment rate dropping to 6.9%. This has influenced the Bank of Canada's likely decision to maintain its benchmark interest rate, aligning with a neutral monetary policy stance. In the U.S., the fiscal landscape saw a significant development, with the Treasury Department reporting a $27 billion budget surplus in June, largely due to increased tariff revenues. Despite this, the federal budget deficit remains high at $1.34 trillion. Corporate news highlighted Levi Strauss's 11% stock surge after exceeding sales and profit expectations, and PriceSmart's 6.5% rise, following strong quarterly results and expansion plans into Chile. The Justice Department's approval of T-Mobile's acquisition of U.S. Cellular boosted the latter's shares by 4%. In the tech sector, Bitcoin briefly hit an all-time high of $118,000, amid Nvidia's valuation surge, ahead of the U.S. Congress's Crypto Week, which could impact future cryptocurrency regulations.
Legendary Entertainment LLC, backed by Apollo Global Management, is reportedly considering an acquisition of Lionsgate Studios Corp., following the latter's separation from Starz Entertainment Corp. This potential takeover, still in preliminary stages, initially began with discussions about a collaborative production of films to assess compatibility between the two companies. The news of the possible acquisition has already impacted the market, with Lionsgate's shares rising by 8% upon the report. Lionsgate, with a market capitalization of $1.8 billion, is an attractive target due to its ownership of lucrative film franchises such as John Wick, The Hunger Games, and Twilight, as well as its successful TV productions like Mad Men. This development comes as Legendary seeks to expand its footprint in the entertainment industry, leveraging Apollo's financial backing for strategic acquisitions. Legendary's CEO, Josh Grodd, has previously indicated plans to pursue multi-billion-dollar takeovers within the sector. The acquisition of Lionsgate would not only enhance Legendary's content library, but also provide a theatrical distribution network, potentially bolstering its market position. The move reflects broader consolidation trends in the media and entertainment industry, driven by the need for content diversification and distribution capabilities in an increasingly competitive landscape.
Lamb Weston Holdings, Inc., LW, is emerging as a potential takeover target in the food sector, trading at a relatively low valuation of 16 times its projected 2025 earnings. The company is benefiting from operational turnaround initiatives and cost-saving measures that are expected to enhance profitability. Additionally, activist investor Jana Partners' involvement may increase the likelihood of a buyout, adding to the stock's attractiveness. The company's shareholder value is further bolstered by a dividend yield of nearly 3% and an ongoing share buyback program, which could become more appealing if interest rates decrease. The recent acquisition of Wheat Kellogg by Ferrero Group for $31 billion, which resulted in a 30% surge in Wheat Kellogg's stock price, underscores the potential undervaluation of food stocks like Lamb Weston. This trend may signal increased merger and acquisition activity in the sector as companies seek to capitalize on undervalued assets. For investors, Lamb Weston's current stock levels present a compelling opportunity for a small position, with potential upside from both operational improvements and the possibility of a takeover. However, risks remain, and investors should weigh these factors carefully in their decision-making process.
Fortrea Holdings, Inc. is the subject of a class action securities lawsuit filed by Levi and Korsinsky, LLP, alleging securities fraud that affected investors between July 3, 2023 and February 28, 2025. The lawsuit claims that Fortrea made false statements about its financial health, specifically overstating revenue projections from long-term projects and anticipated cost savings from exiting transition services agreements. These alleged misrepresentations reportedly inflated the company's EBITDA targets for 2025, misleading investors about the viability of Fortrea's business model and financial prospects following its spin-off. Investors who suffered losses during this period have until August 1, 2025, to seek appointment as lead plaintiffs in the case. The lawsuit, led by the experienced firm Levi and Korsinsky, highlights the critical importance of accurate financial disclosures for publicly traded companies. The outcome could have significant implications for Fortrea's stock performance, investor confidence, and strategic decisions, while also potentially setting a precedent for future securities litigation. Affected investors can join the class action to potentially recover losses without incurring out-of-pocket costs.
Petco Health and Wellness Company, Inc., NASDAQ, WOOF, is currently embroiled in a class action securities lawsuit initiated by the law firm Levi and Korsinsky, LLP. The lawsuit accuses Petco of misleading investors about its business model, particularly its reliance on premium pet food sales and the sustainability of growth experienced during the COVID-19 pandemic. Investors allege that Petco exaggerated its capacity for sustainable, profitable growth while downplaying the challenges and necessary adjustments to its strategy, resulting in misleading public statements. The class action encompasses shareholders who purchased Petco shares between January 14, 2021 and June 5, 2025, a period marked by the company's struggle to maintain its pandemic-era momentum. Affected investors have until August 29, 2025, to apply for a lead plaintiff position. This lawsuit highlights the potential financial and reputational risks for Petco, as the resolution of these allegations could significantly influence the company's stock performance and investor confidence. Furthermore, the outcome may affect broader market perceptions of companies that experienced rapid growth due to pandemic-related circumstances. Levi and Korsinsky is seeking to recover losses for shareholders without requiring any upfront costs from participants.
Mercado Libre, MELI, a leading e-commerce and fintech company in Latin America, recently demonstrated the importance of swift decision-making in swing trading, as highlighted in an analysis from Investors Business Daily. The company experienced a significant stock movement, initially showing promising gains following a 20% rise after a breakout and a positive earnings report. However, the stock faced a rapid decline, erasing a week's worth of gains within 90 minutes, underscoring the volatility and unpredictability inherent in swing trading. This scenario exemplifies the quick and the dead investment strategy, where quick sell decisions based on technical analysis can help preserve profits in a volatile market. The article highlights the use of technical indicators, such as the 50-day moving average and the average true range, ATR, in managing swing trades effectively. By adjusting position sizes and profit goals based on market feedback, investors can mitigate risks associated with individual stock volatility. The swift exit from Mercado Libre's position, despite the lack of immediate news, illustrates the strategy's focus on technical signals over fundamental analysis. This approach allows investors to avoid prolonged exposure to potential losses, maintaining portfolio health in uncertain market conditions.
In 2025, the silicon wafer manufacturing industry is poised for significant growth, driven by the escalating demand for semiconductors essential for advanced technologies such as AI, 5G, electric vehicles, and IoT. The critical role of silicon wafers in the production of microchips, which are foundational to these technologies, underscores the strategic importance of investing in this sector. With governments worldwide emphasizing semiconductor self-sufficiency, coupled with private sector investments, the industry is expected to experience robust growth. This environment presents high potential returns for investors, making silicon wafer manufacturing a lucrative opportunity in the digital economy. Setting up a silicon wafer manufacturing plant involves a comprehensive evaluation of market dynamics, operational workflows, and economic considerations. Key operational steps include site selection, facility design, machinery procurement, and quality assurance, all of which require significant capital investment. The economic analysis outlines the financial viability of such projects, highlighting factors like capital and operating expenditures, revenue projections, and profitability metrics such as net present value, NPV, and internal rate of return, IRR. Additionally, the regulatory landscape necessitates careful navigation of licensing and compliance requirements, which are crucial for operational success. As the industry addresses supply chain disruptions and leverages technological advancements, it remains a pivotal component of the global semiconductor supply chain.
Waste Connections, NYSE, WCN, has demonstrated significant outperformance over the last decade, delivering an average annual return of 19.05%, surpassing the broader market by 7.68% annually. With a current market capitalization of $47.38 billion, the company's stock has shown the power of compounded returns, transforming a $100 investment made 10 years ago into approximately $576.79 today, based on its current share price of $183.38. This performance highlights Waste Connections' robust growth trajectory and its capacity to generate substantial investor returns over the long term. The company's success underscores underscores the importance of long-term investment strategies, particularly in well-managed firms with consistent growth. Waste Connections' performance may influence investor sentiment positively, potentially attracting more interest from those seeking stable, long-term growth opportunities. The broader implication for the market is a reminder of the potential benefits of compounding returns, reinforcing the value of patience and strategic investment in quality stocks over time.